Hello again. Question 3 of the tutorials this week. Below are the separate statements of financial position of parent limited and subsidiary limited at 31 December 2021. They both operate in the same industry. So you have the financial statement. Anytime you get a financial statement, ladies and gentlemen, pay attention. Look at what is there. So here we have PPE investment, current assets. Under the equity, we have ordinary shares, land revaluation reserve, other components of equity. So if you have other OCI item, you record or you recognize them in other components of equity. For example, if the parent issued shares and it's issued at market price and you have the nominal value will be recorded in ordinary shares, and then the excess, which will normally be in share premium, because you've been giving other components of equity, you can then post the premium there. You don't have to introduce a premium account. You will introduce a premium account if there is no other component, or if there is a premium account, then you record the premium in it. But in this question, you've been giving other components of equity, so your premium can be posted there. Okay, so you have to understand other components of equity for what it is. They will name, and then any other component they will put it there. So if you have any OCI item, you record it there. All right, so we have studied our financial statement, retained earnings, and non-current liabilities and current liabilities. Always pay attention to your financial statement. Like I said, you do the consolidation by yourself because we have learned to add. We have learned to add. We have learned to eliminate step 2. What we have not done is the intra-group, the step 3, and that will be the issue for next week. But all these things we are doing, we have read on them, we have studied them, and they are all within step 1 and 2. The fair valuation is all about determining your net asset, fair valuing them, purchase consideration, fair valuing them, calculating goodwill, and all that. They are all in step 2. Step 3 is elimination of intra-group transaction, which is our topic for next week. So the following information is relevant. On 1st September 2021, parent acquired 80% of equity share capital of SAB Limited. The consideration consists of two elements. A share exchange of 3 shares, 3 shares in parent for every 5 shares. So this is 3, 4, 5. 3 for 5. So you must determine the number of shares acquired, divide by 5, multiply by 3, and the parent share price. The second is 6%, is the issue of 100 Ghana cedi 6% loan note for every 500 shares. Again, 80% of shares acquired. Let's check the number of shares. The number of shares, 5,000. Number of shares, 5,000. Therefore, 80% of that, 8% of 5, 8540, so it's for 4,000 shares. 4 million shares. We should have 3 zeros here, I think. So it should be 4 million. So this is 5 million shares 80% is 4 million shares. Please take note of that. It's a correction I had to do, but you have the correct question with the three zeros. So it's 5 million. 80% of that is 4 million. Okay, so you take the 4 million and divide by 500 shares and multiply by 100, and that's your loan note. So two elements. I am positive that if you go through all the previous question, when it comes to purchase consideration, we should be comfortable by now. Just go ahead and practice and get used to it. Okay. Now, I want to also let you notice that the acquisition date was 21st September 2021, and the reporting date is 31st December 2021. So, you are consolidating for September, October, November, December. 4 months. 4 months. It is so important to determine your date of acquisition according to IFRS 3 acquisition accounting. Step 2, determine date of acquisition. It tells you how many years or days or months of consolidation you have to do, and tells you the pre-acquisition items and the post-acquisition items. This question will highlight some of these things. At acquisition date, the fair value of SAB Limited's assets were equal to their carrying amount with the exception of its property. This had a fair value of 1.2 million below its carrying amount with remaining useful life of 8 years. This question is to help you to know that when we talk about fair value adjustment, it's not always about increases. It can also be a decrease in the value of the asset. So the entity is carrying an asset whose value is below the market value. So when they check the market value, the asset, the book value is higher than the market value. That's what it means. The book value is higher than the market value. So we must reduce that asset to its market value, which is below the book value. So that's what it is. So it's not always that it is an addition. In this case, 1.2 will be deducted. And once you have a depreciable asset, you fair value a depreciable asset, you must always deal with the extra depreciation. In the previous question, the extra depreciation is deducted because it's an increase in the value of the asset. So we deduct extra depreciation. Here it is the decrease in the value of the asset, and therefore we add back and the extra depreciation because we have depreciated already an asset which is higher than it should be. So the depreciation is over depreciation. So we add back. Right. So again, this asset, for example, you have 1.5 million divided by 8 times 4 over 12 because you are consolidating for 4 months times 4 over 12. If you use 1 year, you are wrong. 4 over 12 for the depreciation. Now, parents' policy is to revalue all property to current market value at each year end. On 31st December, the value of SARS property remained unchanged from its acquisition date value, but the land element had increased in value. So what it means is the land element at acquisition date, there was no change, but by the date of acquisition, it has increased, and therefore we will add that also to the asset because It is not yet